Hello, welcome back everybody. This is going to be a video where we're going to go through the cross asset class analysis and derive at a trade. First of all, we will understand what impacts the market the most, what variable is we should be looking at the most, and what's the next trade essentially. What's the process pointing to? And let's start going through currencies, crypto, fiat alternatives, credit, equities, world equities, and arrive at a trade, at an the most important trade right now. So the dollar. I want to preface everything by saying that we already know what the most important variable right now is. It is rates, obviously, US rates, US long end. It has been, and for the last 2 years, the thing that everything else is hinges upon. If rates go up on a trending basis, everything else goes down on a trending basis. Even the relationship is even so strong that it is being true on a trading basis, meaning if rates break into the upside on a trading basis, everything else breaks down on a trading basis. And I will show you this relationship in between the equities, credit, and rates on the charts right now. The currency, the dollar. The dollar is, let's start with the big picture overall. Look at the monthly and look at the weekly. Let's look on the trending basis, on the tail basis. On the tail basis, the dollar has not yet turned into the negative territory. For this, we need a couple of months to pass to receive that confirmation that yes, we are in a negative tail territory for the dollar, and this is a very strong signal to short the dollar, to be in short the dollar, but it's not yet the reality. We are bearish trend though right now currently, with the trend is being at 104.26, and positive trade though on the dollar. This is the setup of a potential. This points to the potential retracement over the next couple of weeks, and just potential consolidation. And it's a consolidation and rebounding setup. Being in a negative trend territory, though clearly breaking the trade. Everything else in currency support the same conclusion as well as everything else in rates support the same conclusion. So this is the setup currently for the Dixie. We have the CPI report that is going to be very indicative of the upcoming future, and whether we're going to create this ultimate another lower high on a trending basis right here and continue lower, or this is going to be a prolonged consolidation with a bounce higher and then a continuation lower. We don't know that yet, but as I outlined in a previous report, we're going to be trading the CPI as an event, no more, no less. We don't believe that the CPI will be enough to change the market expectation of the future policy markedly enough in order to change the trend for the currency overall, and for the Bitcoin overall, for the credit overall. So it's more of a inside volatility. Okay, now the dollar is negative on a trending basis, positive on a trade basis. There's nothing to do here. We don't see any trades currently to be had in currencies. JPY is pointing to the fact that yes, we've reached this low on a trending basis for rates and for currencies. JPY is very correlated and very sensitive to the forward expectation of the Fed policy, and JPY is signaling the potential creation, the high probability of a creation high-low right here on a daily basis. All of this points to the continuous consolidation within that region, meaning this is not the time to short rates, to be long of, meaning to be long of gold or to be long of TLT. Rates are gonna be bound in the range probably with variance. I don't know what the volatility will be, but this is not the time to be short of JPY, meaning no, we're not gonna get lower rates, meaningful lower rates right now in the US, or continuation of the trending move in rates lower. No. This points to bounce higher and consolidation right here, meaning higher rates for the time being, for the short term at least. Same thing with the dollar. This points to the continuous consolidation in that region for the dollar. And one very interesting thing to highlight, even though we're getting this retracement in JPY, we're getting this retracement in rates in the long end, in 10-year and 30-year. Once again, the JPY points to the fact that this move has largely exhausted itself. This is not the time to be short and to expect that this is going to reverse and go down to 3.8, 3.7, 3.5, meaning I'm talking about the short term right now. I'm talking about the next 1 to 3 weeks, the next month. This is not the case for the next month. Maybe this will happen in the next 3, 4, 5 months. We don't know, but this is not the case. We're looking at the short term currently. And short term implies a continuous retracement in rates, therefore in equity, therefore in everything else. One very insightful conclusion that we can draw from the currency market is the reaction of a USD MXN. With this retracement in rates, the only thing that in currency space that we track that hasn't moved and hasn't reflected this moving rates higher is USD MXN. What does it mean? This means that there is no growth scare. There is no volatility pickup. We having this retracement in equity with the SPX break-in trade support, and volatility at the same time is falling, and it's all right. It has. This points to the fact that there is no immediate danger. This is not the end of a bull market or end of a serious move in equity space. This is more of your ordinary consolidation and retracement on a trending basis, which takes time, but overall USD MXN points to the fact that growth is still stable, everything is all right. Volatility will likely to remain to be subdued, and after that we shall see a rebound and continuation higher in equities. And in itself, the fact that this behavior in Mexican peso points to the continuous strength in Mexican economy and the continuous strength of incredible inflows into the Mexican economy, and therefore we gotta look for longs right there, and the obvious longs in the things that we're looking at and the things that we want to put on are EWW. This is the pure play. Obviously, you just buy the ETF, the country ETF. That's it. And the other thing is AGUA, Agua. This is a company which is a beneficiary of a larger theme we think of is the water scarcity, and it has been. It is undergoing a meaningful shift in a management, and overall the fundamentals are positive. The theme behind it is positive. The country in which it's situated is positive. The currency is positive. Everything is positive right here. So this is the thing we are looking to buy on dips right now. We'll get to this a little bit later when we talk about the potential trades, though. But once again, USD MXN points to a fact that the environment that we find ourselves in is very supportive of equities. The environment is just fine. The variance in price that we've seen, the volatility in price and the relative volatility in price in equities, this retracement that we've seen, is completely tied to the volatility in interest rates, to the moves in interest rates, to this move in 10-year. Just an ordinary repricing of rates higher after this exhaustion move, after this the time when, once again, this move happened on the back that we received a positive QRA announcement right here, and then a couple of positive CPI reports, and we priced in a lot of cuts. I mean, a lot of cuts. Yes, they pivoted. We can say that the Federal Reserve has officially pivoted, but the median dot plot once again is for 75 basis point of cuts, and right now we are pricing in more of a 125, maybe even, well, a couple of weeks ago we were pricing in 150, and it's just natural volatility in interest rates tied to the expectation of a policy. That's it. And after this peak of pricing of rates, which is rebounding. The expectations are rebounding, and the rate complex is rebounding with it, bringing everything out because of the incredibly strong correlation to everything and bringing everything else down. But the USD MXN points to the fact that this is just it. This is the volatility in interest rates that impacts everything else. No more, no less, no problem at all. In the vol space, no problem at all. There is no growth scare or anything to be scared of at all. So this is nice. This is okay. This is a very positive signal, and just overall supporting of our conclusion that we are making right here. That this is a very nice and potentially good environment for taking on risk. Good macro environment for taking on risk. Good. We have to live through this CPI report, and we have to live through the next QRA announcement, which will be very, very significant, which will come out at the end of this month. And if all else remains equal, if the CPI is a non-event or slightly positive or slightly negative, it's okay. If the QRA announcement will not hold any meaningful surprises for the market, or removal of liquidity, or they will shift and move away from the excessive bill issuance into the coupon issuance, then everything else should be fine. And by the end of this quarter, maybe maybe in February, but by the March time, we shall see the pickup in equity prices again and continuation higher. This is the overall picture right now. This is what the currency market is pointing in, meaning that the dollar should start falling by the end of Q1 again. That is fine. That is the currency market and USD MXN. Is there a trade to be had in USD MXN? Well, yes, if you trade currencies, that's fine. But this is not the best way to express this theme. We think the best way is to play this through EWW or go in and look for the specific equities. And the one that we found is Agua, and we will go through this. That is fine. That is fine. Currencies are completely fine. Everything in currency there is a same setup everywhere right now. Bullish trend, yet the bearish trade. This is a consolidationary setup that takes a couple of weeks to resolve, and we shall see what will happen right there. But USD JPY supports the rebound in rates, continuous rebound in rates, meaning that it's not the time to be short rates. Same thing USD CNH. The other thing that is quite sensitive to rates and rate differentials right there is USD CNH. USD CNH shifted into the positive trend territory, which is very interesting. USD CNH has been incredibly weak for the last 2 years, and the HSI and the Chinese markets remain markedly weak compared relative to everything else in this world, and the currency as well. This just points to the fact that, well, they have some problems. They continue experiencing some meaningful problems that has not been able to resolve. So I don't know. I don't know what to draw from this, but this is a serious signal. The fact that the USD CNH is the only currency pair that has shifted into the positive trend territory, meaning this is weakness. If we're talking about the USD CNH, this points to continuous weakness in the CNH. Everything else is just rebounding on a trade basis against the dollar, but USD CNH broke the trend resistance, and this is very meaningful. This points to the continuous weakness in USD CNH or underperformance relative to every other currency, and this points to the continuous weakness or at least underperformance in their stock market, in HSI, in the names like Baba PDD and all that stuff. Is there short to be had? I don't know, honestly. I don't know. We don't like to just to trade China. We don't understand it. And this just points to the fact that there are some problems, and will they be resolved by using the economic means, or will they be resolved by escalating the geopolitical tensions? We don't know, but this is a serious signs of weakness in Chinese economy and in Chinese markets overall. So this is it. This is what I want to say about China right here. Let's now talk about the rates. We talked about the dollar, which is the derivative of rates currently, and this is the rates. Once again, USD/JPY, the dollar, the 10-year and the 2-year. Everything points to the same thing. Everything points to probably something like this happening again. Some sort of consolidation within the probable range. The probable range is right here. This is the range that we are having currently. We do not expect over the short term, meaning over the next 3 weeks, the 10-year to reach 3.8 or even break lower. This is not the expectation. We would expect the continuing move higher or consolidation in that region, and the CPI will be largely telling right here. We think that CPI will not come out too much, will not be dovish enough, and we think that the March rate cut should be priced out of the market. Therefore, this is our overall idea, this is our overall picture and thoughts going into this week. But obviously, we will adjust ourselves and make decisions more closer to the CPI print itself, which is going to be on Thursday. But overall, the USD/JPY once again is pointing to the higher low on a trading basis. US 10-year pointing on the higher low at the high low on a trading basis. The probability of a creation of a high low on a trading basis is very high. The 30-year is pointing to the same thing. The 2-year is pointing to the same thing. The 10-year in Europe pointing to the same thing. In Germany, in UK, France, Italy. Everything is pointing to the continuous weakness, to the continuous strength in yields over the short term, and weakness in equity over the short term as well, regardless of the CPI. So this is our opinion. First of all, there is no trade to be had in TLT. We don't see anything. Everything that we've just discussed points to the continuous weakness in TLT and potential retracement and retest of 93.56, which was the previous trade support. But mind you, this is positive. TLT is positive on a trend basis. 10-year is negative on a trend basis. Dixie is negative on a trend basis. JPY is negative on a trend basis. 30-year in Europe, in US, is negative on a trend basis. It just means that, once again, this is a short-term rebound in rates. This is not this. This is a short-term rebound in rates, meaning that short-term low for the yields is in currently, and now just a matter of volatility in the market expectation of a future Fed policy, and that's it. And once again, we don't think that the volatility will be that significant because the range of probable outcomes has narrowed meaningfully, meaning whether we're going to price out the cut in March or we're not going to price out the cut in March, it's largely irrelevant. It is not going to shift the trend dynamics meaningfully. It's just going to create volatility within this certain range, and that's it. What's the next play? We shall see at the QRA whether we will continue this trend lower in yields. We don't know, but one thing we know for sure that, and the thing that the history has shown that, let's put SPX above the rates right here. Even if rates remain in, first of all, once again, look at this correlation. Rates lower, SPX higher. Rates higher, SPX lower. Rates lower, SPX higher. Rates higher, SPX lower. The correlation is spot on, very, very tight, and it remains very, very tight. But the thing that point out here is, look right here, is this move. This is rates breaking out on into the positive tail and trend territory. This theoretically should be negative for the SPX, but SPX at that time printed an incredible move higher, and this just points to the fact that rates can remain subdued with a certain volatility in a certain range, but at some point, once again, SPX and equity can break out higher, regardless of what rates are doing. So consolidating rates are neutral to positive for the equity. and this is what we're playing, this is what we're thinking of playing. A very, very important signal right here. This is okay, this is fine. We will get to the... we're just observing the overall picture right now, but we will get to the how we think of playing all of this on a trend basis, and how we think of playing this on a trade basis as well. These are rates. I think I've described the current rate situation quite clearly. Retracement on a trade basis, or into the short term on a short term basis, and a consolidation on a trending basis. So this is the conclusion for the rates. Same thing goes. Well, it's just one complex. What the US rates are doing, the same thing European rates are doing. Credit, we'll get to credit. This supports the conclusion that we draw from the currency space. And let's look at the gold as a derivative of what the rates are currently doing. Gold is, once again, just as rates in the US are negative on a trend basis, gold is positive on a trend basis. This is the trend support for gold, and negative on a trade basis. Gold is in consolidation mode as well. Gold is a much better long to be had on a trending basis, and much better thing to hold as a diversifier in your portfolio than the TLT. Yes, TLT bounced significantly from the lows right now. As we saw, that was a 16+% move, but we have to take into account the continued underperformance of the TLT and the move that we've seen before that, right? In order to look at the aggregate, but the gold remained with much lower volatility and much stable returns over the same time period. And gold, once again, points to consolidation, but this is, if there is a time to buy gold, it's now. There is a very good argument for being long gold currently, and having a 15-20% allocation to the gold, regardless of the short-term fluctuations. If the CPI comes in higher than expected and market will price out some of those cuts, gold will take a beating, obviously. But once again, this is your probable range. We're going to move in this probable range. We can even retest the trend support, but overall, the trend, the tail situation in rates, the tail situation in currency, the tail situation in gold, and the trend situation in all of those things point to the same conclusion. Higher gold, lower consolidating rates, at the same time higher gold, and relatively negative Dixie over the same time period. So gold, this is it in gold. If you want to play it on a trade basis, you have to look at the CPI. If you want to play on a trend basis, I believe this makes a lot of sense just to be buying leaps on gold. 1 year, 2 year calls makes a lot of sense. Volatility has fallen in GLD significantly. You can play it through GLD if you want. So at the low volatility, with the outlook that we have currently, buying leaps is a very great way to hedge your portfolio. What do I mean by hedge your portfolio? Everything essentially is correlated. The correlation between, once again, dollar, gold, Bitcoin, SPX, TLT is very, very strong. And the one thing that gold offers is geopolitical risk premium, which is very high right now and will continue to increase, we think. If we get some sort of credit event, we know what they're going to do. They're going to extend some sort of new BTFP program or anything else like that, and gold will skyrocket from there, just as it did right here in this instant. We're going to see the same thing in gold. If you're going to see a recession and continuous repricing, serious recession, meaning the serious rise in unemployment, is going to force rate cuts onto the Federal Reserve, meaning we're going to see same thing happening right here. We're not so certain that we're going to see the same great repricing high in TLT, Now, just because at the same time, as we go in, if we go into recession, the fiscal will usually expand, the fiscal spending will usually expand, and the supply will come on even greater, means more liquidity, more debasement of the currency, and not so impressive returns for TLT. But gold shall remain in a nice spot. The biggest risk for the market overall, for gold, for rates, for everything, is a significant spike back in inflation. We know how to hedge against this, and we believe we know how to foresee this. First of all, as I've been saying, we're not going to get a significant spike in headline inflation without a energy crisis, meaning oil prices have to spike again. And we observe oil prices very, very carefully on a daily basis, and there is no sign on a short-term basis that we're going to see a meaningful spike in oil prices. So therefore, so far, everything is fine. The conditions are stable. No spike in inflation is projected for the short term, and for the medium term, everything is fine then. Meaning we don't have to hedge against inflation, against stabilizing inflation at this high level at 2.53%. That is fine. It is stabilizing at this higher level, meaning some cuts will be priced out, meaning negative price action for the equities on a short term, positive price action for the rates on a short term, for the dollar on a short term, for the gold on a short term. But overall, the trending conditions remain the same. And this is what I want to say about gold. And this is what we're gonna do if we see a rebound in gold prices lower on the hawkish CPI report. If we get a hawkish CPI report, we're gonna add to our long-term gold calls. We don't think gold is going to perform very well in the condition that I just described, that the rates in the US will remain in consolidation on a trending basis, meaning for the first quarter of this year at least, gold is probably, well, with the rates, let me put on the TLT instead of rates. No, bad idea. Let's look at the rates. Let's look at it on a daily basis. This significant move lower in rates caused a significant move higher in gold. And if we expect, once again, if we look at the rates on a positive on trading basis and some sort of consolidation within that area, same thing we should expect gold to do over the next little while, maybe month, 2-3 months, we don't know. But overall, at the end of the day, gold leaps make a lot of sense. I mean, a lot of sense. And usually with the gold price, when we have spikes in with this very low implied volatility currently, very, very low implied volatility rank, implied volatility percentile, volatility tends to spike in gold when the price moves higher. And therefore, if we're going to get some sort of recession, geopolitical event, gold, what will gold do? Gold will spike higher. The delta will go higher, and the volatility will expand as well. Therefore, those leaps will put you in a much nicer position, even if you had just a linear allocation to gold, just a straightforward, you would have straightforward just bought the TLT. So the consolidation in rates, consolidation in gold on the short term, that is clear. Yes. Let's look at the BTC and equities and credit right now. With this break in trade in rates, with this break in trade in HYG, in credit, in equity, in SPX, lower, and BTC remains incredibly resilient. And usually BTC leads everything else. We have found, well, we didn't pay much attention to the BTC and the relationship between Bitcoin and SPX on a trading basis. On a trend basis, we know that it literally front runs everything. I can point to the right here. Let's look at the SPX and let's look at the GLD as well. On a trending basis, it does front run. Oh nope, this is GLD. By the way, look at this look at this relationship. This is the current environment. Everything is correlated. Everything is in very, very tight correlation with each other. Look, rates falling, SPX rising, gold rising. We're having these problems with the supply, rates rising significantly, SPX falling, gold falling as well. But this is not what I want to show you. I will need GLD. I need to put the GLD on top, and I need to BTC. Look at the Bitcoin. The correlation is very, very tight. But if you look, I hope you can see this. Right now, right here, Bitcoin has shifted into the positive trend territory. Right here on this day. Well before the SPX shifted into the trend territory right here, and gold shifted into the trend territory right here. Bitcoin front runs gold and SPX by a couple of days, even a couple of weeks. So Bitcoin in itself is very pure representation of underlying liquidity, and it would be unwise to ignore the signal that we are being provided by it. What I'm trying to say is the continuous and obvious resilience of Bitcoin and its ability to currently create a trending high-low on right now, and the fact that it didn't even break the trade points to the continuous resiliency in SPX, meaning this retracement once again in SPX and credit is not going to be a very long-lasting and not going to be a very significant or vicious one. So this is what we can draw from Bitcoin. Bitcoin right now is standing below its tail resistance. As you can remember, we called for a break in 32,000, 32,000 range, this range right here, and well, essentially we had this repricing. The way that Bitcoin trades right now is pointing to the fact that we are going to break this trend tail resistance right here with this consolidation, with the creation of a trend high-low below this tail resistance. We would expect, if all else remains equal, this thing just breaking into the positive tail territory. And not to say that this is the beginning and continuation of this move. No. We believe that if we do break higher, there's a great probability that we're going to see a vicious move lower. But this is in the future, in 2-3 months ahead. Right now, on a short-term basis, on a trending basis, Bitcoin is a great buy and great hold. The other thing to say, even if we break the trend support right here, all this area, all this region is a great opportunity to add, but we don't believe that the breaking of this level is a model outcome, is a high probability outcome. Most likely, we're going to stay in this range with some sort of a volatility, with some sort of variance within the range, and challenge the trend support tail resistance in the near term. So this is the outline for BTC. Very positive picture for Bitcoin overall, very positive, and it is across everything. We just look at the futures. This is the spot market, same thing right here. Bitcoin, if we treat Bitcoin as a reflection of underlying liquidity in the system, this is very positive. I do not point at, yes, we are aware of the ETF situation and the flows that may be impacting the market because of this ETF or hype and ETF situation, but our signal, especially on a trend basis, is very agnostic to all of this, and we can discern the noise from the actual facts and from the meaningful shifts and inflection points Therefore, we're not really worried about the ETF, or we're not putting much of an emphasis of an ETF while doing this analysis. So, this is another plus for a long equity and for long beta, long risk on scenario. So this is fine. Before we get to equities, before we get to credit, no, let's discuss all of this. This is the conclusion that we can draw from Bitcoin. The credit represented by HYG, JNK, and all of this. Once again, this is the first time. Well, looking at the credit, this is a very potent and very strong signal. Just look at this. This is the first time since the beginning of the 22 and the beginning of this hiking cycle that we broke and established the positive tail for HYG. Tail for HYG, let me say this again. This is a very strong signal, very meaningful signal. And usually, and this is normal, after breaking into the tail territory on any instrument and moving that significantly and that fast higher, inevitably we are getting a prolonged and not necessarily deep, but a prolonged retracement and consolidation. And this is what we're calling for right now. Prolonged retracement and a consolidation over the short term, with the high degree of probability that eventually these self-perpetuating dynamics that we're seeing currently in the markets, everything points in equity, in credit, points to the continuous creation of a high low on a trending basis, and another leg higher on a trending basis. How strong this leg higher will be, we do not know, but this is what you have to be preparing for on a trend basis. Higher HYG. And these are the self-perpetuating dynamics. The fact that HYG and SPY is breaking higher in the fashion and the manner that they are doing currently is in itself a very strong signal, because the financial conditions are easing, perpetuating even more easing in financial conditions, unless that is being counteracted and met by the hawkish Fed. But the Federal Reserve at this point completely shifted their gear and shifted their outlook, and they are pointed to the cats. They officially pivoted, and whether they're going to price out some of the cuts, it's just irrelevant at this point. Completely irrelevant. It creates a short-term volatility in the price action, in credit, in rates, in equities. Yeah, but the underlying trend remains the same, and they see this. Honestly, I've been having these thoughts that inflation is all right. Yes, inflation impacts their underlying dynamics with the future Fed policy and the path of the future Fed policy. But there is another thing. The job of the Federal Reserve is to make Treasury look solvent, and by keeping rates at 5.25%, 5.5%, 5.23, 5.25, they are making it very harder for the Treasury to do their job. And the fact that the Treasury has engage in this massive excessive bill issuance is pointing to the fact that they're seeing this problem. Irregardless of what they say, they see this huge demand-supply imbalance in the Treasury market, and they are easing Treasury, using everything in their power to ease this problem, ease this pain by shifting into the bill, draining RRP, and after the RRP is drained, they're gonna start draining bank reserves. And this should be negative, but we are seeing the first signs that the Federal Reserve is recognizing this by releasing their minutes and saying that we have to keep the bank reserves at ample level. We have to keep ample reserves. What do we have to do to achieve this goal? Slow down the roll-off of the balance sheet. Slow down, and the slowdown is the first sign of a complete abandoning of the QT, because they have no other choice, and they're seeing this, and they want to cut rates. And what I'm trying to say right here is they really want to cut rates, regardless of what they say. They see this problem in the Treasury market, and not only by engaging in QT and by raising, they are making it harder by keeping rates at this level, so they have to drop rates to 4, at least 3%. That would be much easier for the Treasury to do its job. and this is what they want to do. This is why they pivoted, even though inflation hasn't dropped completely to their target. And I was surprised by this pivot. To be honest, I was really surprised by this pivot. But now I see why they're doing this, and the trend in their policy, regardless of what inflation is doing, even if it's stabilizing at this level, they will cut rates this year, and they want to get rates lower. And I think that the hawkishness is the model outcome at this point. More hawkishness. Even if CPI comes in a little bit hotter than expected, at this point, if in 2022 it was the dovishness. I wanted to say the dovishness. If in 2022 the model outcome was to expect them to be more hawkish, this time around it's reversed, and it makes a lot of sense, regardless of the inflation, to expect them to be more dovish, to expect them to be more on a dovish end of things. So this is quite meaningful. Hey, so this is signal for HYG. And there is a very nicely backtested pattern that we've been observing in our process, that after the shift in positive trend territory and tail territory, once again, as I just outlined, when we first shift in the positive tail territory and we getting very extended, there is a great chance for prolonged retracement and stabilization of the market overall within a certain range, and then continuation higher. But there is another thing. The first break in trade in that instance, after they shifted higher and broke the tail resistance right here, the first drop into that zone, into the tail, once the tail resistance, is meant to be bought. Even though this looks very obvious, and from technical analysis this looks very obvious, and everybody knows that this is a SAR level, and if the level is incredibly obvious and we finally break this, this is your first retracement and you meant to buy it. I do not like that this is so much obvious and everybody knows this, but it doesn't make it it doesn't make it irrelevant, or it doesn't make it less effective. So it's just a matter of price action at this point. If there are a couple of ways that we can create a trending higher low, we are waiting for the creation of a trending higher low, and there are a couple of ways that we can make it trending higher low. This is with a significant amount of volatility within that retracement, meaning creation of an intermediate lower high, move higher, and then recess of intermediate and continuation higher. There is a slow grind lower. This is what, by the way, this is what we're currently observing, and with HYG and SPX as well, with this window of weakness opening, as we've been observing Vana and charm flow slowly coming out of the market, and market is just grinding lower with the volatility dropping at the same time into the key level. And at the end of the day, this is what you want to buy. If we are continuing grinding lower right here, this is what you want to buy. This is the time to be buying at risk with your eyes closed. The other thing I want to point out, every single breakout higher right here on a trade basis in 77, 78 is meant to be sold. If you are seeing a pop right here, it's meant to be sold. Even a CPI comes in, let's say in line, and we're seeing the pop in HYG and SPX, this meant to be sold, because we are going lower right here. The flows are decisively negative on a short-term basis. Okay, this is a signal that can be drawn from the HYG, and it is pretty serious. We are not getting recession while the HYG and credit breaking out into the new highs, cyclical highs. I mean, you're just not getting this. And I can assure you that this is not this type of movement. This is not your V top, because there are no such things as V tops. There are V bottoms, but no V tops. Surely, well, everything can happen. New wars can break out, but this is the exogenous events that we cannot account for, but we will be able to react to them when they come. The biggest situation is QRA. The biggest catalyst is QRA, which is once again 29th of this month, and we think with the with their realization and with the fact that we are in an election year, why would they create even more problems for themselves in an election year in order to solve them a little later on into this year? I think the QRA should be just fine. They will do everything in their possible power in order not to surprise the market with negative numbers of coupon issuance, or with any negative news. As it relates to QRA announcement, me thinks it would be prudent if they want to achieve what they are trying to achieve. That is fine. That is HYG. SHYG points to the same thing. GNK, well, it's just the extension of the same thing, points to the same thing. LQD points to the same thing. BKLN points to the same thing. PFF points to everything in credit points to the same thing. VMBS, mortgage ETFs point to the same thing. Everything points to the same thing. Same as we just discussed on HYG. That is fine. That is nice. That is fine. That is nice. Let's just look at this. Just a couple of macro points. This is from the open interview that 42 Macro gave maybe a week ago. Very relevant still to this point, and we've just discussed what we think is happening. Not what we think is happening. What is the highest probability that we can discern using our signal, using the cross asset class analysis that we use. And mind you, this cross asset class analysis has been very accurate this year around. We played 2022 very nicely. We played this TLT drop that happened after the QRA announcement very nicely. We played this. We essentially, if anything else, we are able to recognize the most important inflection points in the market. This cross asset class analysis has not yet, even once, let us down in terms of recognizing the key inflection points in the market, and this is one of them. This is just what I've been discussing. We are in the midst of another key inflection point in the market. All right, this is what the conclusion that we draw from this. And we largely agree with those conclusions. Cross-asset class analysis and qualitative research suggest that the current Goldilocks regime will likely persist over the next 1 to 3 months. Things like the dollar establishing negative trend momentum is still positive tail, but we believe that during the first half of this year, we might see it breaking tail. Bond market will coming down, oil prices still falling by the way. Very dovish but quite reasonable pricing in store markets. All of these things support the current regime. All of that has been said there is still relevant. Once again, I'm going to keep repeating this, but the underlying trend dynamics is positive for the equities. The thing that is gonna define the path within that consolidation is this option flow, option flows, CPI reports, and ultimately QRA. QRA can be this break or make type of deal if it just for some reason comes in incredibly bad and the numbers surprise the market significantly, we can completely destroy all of I've just said. But this is not the model outcome. If it comes out just neutral and the market perceives this as neutral, beautiful. We think that this will be, that for this market, neutral means positive. So this is what we have. We use they use the macro weather model and qualitative research to determine how long the current top-down market regime is likely to persist. And we utilize their tools in order to help our tools. We are able to identify the direction, and we are able to identify the meaningful and the most important inflection points. One thing we are not very good at, and essentially it is very hard for anybody to not only get the direction right, but we can get the path right. But not with the same degree of certainty as we get the direction right. But the magnitude of this move, and the time of this move, meaning how long the conditions will likely to last, how long and how far the trend move will take us. Nobody knows that. I mean, this is everybody's guess, but nobody knows that until you see something changing on a short-term basis, but nobody knows that. But we look at for the two macro data to get the idea of what's the most probable outcome, and we've looked for a lot of resources, and they have been very, very accurate, the most accurate of all. Growth is trending higher. This is I'm just describe what is right here on this picture. Growth is trending higher, and there is no real risk of a fast and serious inflation lower over the next quarter. Inflation is trending lower and is expected to continue to trend lower over the next 12 months, not at an astonishing pace, but somewhere in line with Fed projections unless oil prices sustainably rise. The unemployment rate is trending higher, but in a stable fashion, and the recent bounce in productivity decreases the probability of mass layoffs. This is very important, by the way. There's a thread about the productivity. I'm not gonna be. We'll get to this. Implied sales growth for SPY is trending lower. Implied earnings growth for SPY is trending higher. Sovereign fiscal balance as a percentage of GDP is trending lower, which means that the budget deficit is widening. Liquidity is stable and rising. Once again, dependent on the QRA. Credit growth is trending lower. Interest rate market pricing in 155 basis points of cuts, 75 of which are in the first half of this year. We think you can, just minus 25. You can safely say that we're probably not going to do the 75, maybe 50. Which, if current conditions persist, they are unlikely to materialize, and there are maybe a trade there. One of the most important pieces of data that we received in the last months is a material bounce in productivity growth. It is very important because higher productivity reduces the need for corporations to share costs, fire people, and reduce the need to pass on price increases, lower inflation. All of this supports the Goldilocks dynamics. Now, whether this productivity tied to AI or anything else, there's just everybody's best guess, but we don't know. But the fact that it is rebounding, this is positive for equity and for our model outcome and for our trades that we're taking currently. And this is a significant signal. Avoiding deep earnings recession, meaning no layoffs, and we've seen with the recent employment report that, however accurate the data is, there is no significant and short-term risk for a meaningful unemployment spike. So it is also fine and supports our model outcome. Corporate profitability model indicates a deep earnings recession has likely been avoided. Corporate profits fail to draw down materially enough to perpetuate the mass firing and unemployment required for recession. Inflation is returning to a more normalized level. The improvement in productivity growth also reduced the need for corporations to pass on price increases to consumers. Productivity growth is tracking above trend, however, and may slow in quarters ahead. Rate cuts, fiscal stimulus, and an AI to the rescue. There are potential signs of a sticky inflation, meaning stabilization of inflation in and around the current levels. And we've just discussed how to play this, and we will go into the more details just in a couple of minutes. The next thing, liquidity conditions and fiscal deficits impact on the debt markets. The liquidity conditions are set to stabilize and be supportive in the first half of 2024, even though people might think that the Fed is draining liquidity through the QT lever. This has been offset by factors like the RRP facility and the TGA. You can look at this picture, very telling picture, and the text as well. Because of the political realities, potential dynamics around TGA will likely be supportive throughout 2024, and RRP will likely be continuously drained, which helps to mitigate the potential impact of a large-scale deficit on the debt market's duration lever. Until the RRP is drained, we are unlikely to see a repeat of what happened from August to November, when the surprise in issuance pushed yields higher while dragging the risk assets down. This what happened in that time period. The biggest risk associated with huge fiscal deficits and accommodative central bank policy is the potential acceleration in inflation. But until we get a meaningful spike in oil prices, it is unlikely that we're going to see a headline inflation spike. As of now, oil is firmly in negative trend territory and shows no potential sign of reversal, so this is not an issue over the next 2-3 months. Cross-border capital interview. The liquidity cycle has bottomed in October 2022 and will likely last till the end of 2025. Global liquidity, yeah, these are just points that he's making there. This is a very interesting chart. Fed balance sheet and Fed liquidity, even though they're draining their balance sheet, but not in the pace that they wanted to in 2022. But regardless of that, the bank reserves, they call it the Fed liquidity, has been neutral and stabilizing, even rising over the past year. Yes, especially after the SVB crisis, and this will likely to continue. Well, they are maintaining these ample reserves and will continue to maintain these ample reserves, as I've said, with the recent hint that they've given us from the minutes report. They will do everything to keep this stable. So this is just positive for the market overall. Federal Reserve is lagging. Asset allocation, if history is correct and this chart has any value, then we are transitioning from a rebound phase into the calm phase, and you can see what's the asset allocation currently should be for the calm phase, for the assets and for industry groups. And mind you, this is being supportive by our signal, by cross-asset class analysis. You see, we've just gone through the cross-asset class analysis, and then we came back into the macro, and everything supports one another, and we are looking for the model outcome, and as of now, we can derive at that with a high degree of accuracy. We think we are transitioning from rebound into calm, and just positive for beta and risk, positive for equities. This is should be neutral for credit, and we expect consolidation in credit. This is should be positive for commodities, but we don't see that, honestly, because everything is correlated to rates, and in this backtest over the previous cycles, this should have been positive for commodities by now, but now there are no signs, honestly. No, oil prices point to the downside, copper prices point to the downside, aluminum prices, most of the commodities point to the downside. I don't know, the ag, I didn't really look at the ag complex. No, we look at the ag complex, but we don't trade it. Bond duration should be negative for bond duration, but it would be probably neutral for bond duration. All right. This is it. So now we've gone through most of the names that we look at. We haven't looked at the SPX in a detail, yeah, but just with HYG, just with XPX, everything points to the same thing. How to play it on a short-term basis, I know, and we will be playing, but the short-term basis is a short-term basis. To be taking trades over the next 1 or 2 weeks, or to be putting on trades for the next couple of days is one thing, but we are here, and in this video we'd like to prepare for the trending basis for the next 2, 3, 4 months, and this is what we're going to discuss right now. One thing to say about the short-term basis is we would like to short the SPX going into the SPY CPI report, and we will post the updates in the Telegram channel close on Wednesday if we're gonna put something going into the CPI. Okay, let's come back. Let's start by looking at the what we have on currently and how we think of playing this on a trend basis. Once again, the model outcome is as such. This is your potential area of consolidation. We are in the middle of this range. We've started to lag into the positive beta position, accumulating positive beta positions right now, even though we are completely accepting the fact that we might go even lower and revisit 4600. We are going to be adding into that, but right now, regardless of what happens here, this is your area for accumulation of a beta positions that you like. And this is what we're doing. This is the thing that we started to accumulate with the horizon 2 to 3 to 4 months horizon. These are the things. The things are. Oh, let me open up this one. Let me open up this one, and this is it. We have our long shipping basket, STNG, LPG, TNK, INSW, with, I think you don't need me to tell you about the thing that's going on in the Red Sea, and overall the dynamics and the conflict is inflationary and positive for the companies that are involved in shipping, because this is not just one problem. Maybe there will be something happening in Strait of Hormuz, something happening currently in the Red Sea. There are hundreds of choke points throughout the world, and the more conflict we'll get, and the conflict will perpetuate more shipping costs, meaning being positive for these companies. And one thing to say about all of this, that this is not just a one-time deal. These problems on the geopolitical arena is more of a trend right now, rather than some sort of a outlier event. This will keep happening, most likely, meaning supportive for these companies. And we lagged in. We put on half of the position right here, and we think of adding, let me open up this basket, and we think of adding TDW, FRO as well to that basket, DHT and TPN. We think of adding all of this into that basket. We're thinking of NAC, but don't really like that one. TKA as well is interesting, but this is the thing. TDW, FRO, TNK, LPG we have on, DHT as well. These are the things that probably should be added into the basket as well. And with this, once again, with this consolidation, this beta consolidation that we're currently observing, yes, we will accumulate and put on a full position in all of these names. This should be positive. These companies should feel themselves quite nice in 2024. I lost the train of thought right there. No, that was something important to say. So we accumulated half of the position in these names, and one thing to say about these names is they are incredibly these are like standalone longs, because if you look at all of these companies, the correlation to the SPX index is the biggest correlation is 0.35, meaning they are completely uncorrelated to the index. And what I've been noticing by observing these names over the last year and a half is they're mostly negatively correlated to the index, meaning the fact that we are in this consolidation. Let's look at the STNG, let's say, on a daily basis. The better, look at this, for example. Look at this fall in SPX, and look at this relative strength in STNG. No, let's not do this. Let's look at the basket overall. Look at this. Incredible relative strength, while SPX firmly into the negative trend territory. Then a rebound. These guys broke out much sooner than these guys did, than the SPX did, and then a massive move higher in SPX, consolidation in STNG, massive move higher in SPX, and here they went together. But overall, the correlation to the beta of this portfolio is 0.35, which is very, very low. So the beta component right here, you don't have to worry about the beta component with these companies too much. TD once again, TD, all of these names just above the ZIM. Let me write those down so I don't forget them. TDW, FRO, I have FRO now, FRO. DHT and TNP. STNG, TNK, LPG. We'll have these on, and yeah. So this is one of the baskets that we are currently accumulating and think of adding even more into. That's fine. Next thing, that long GLP narrowed basket, Lily and NVO. This is the staple. We really like Lily right here. The relative strength and overall theme behind it, the strength of the company itself. This is a brilliant move. Long right now. That's why you can see the allocation, 23%. Quite a huge allocation we have currently to this basket. When we plan on expanding this basket and adding some of the biopharma plays, plays that Citrini pointed out, like BHVN, SRRK. The thing that we're going to be adding to these names probably going to be we're going to balance them with GLP-1 shorts, meaning putting on this basket on against these longs with probably 1-to-3 ratio at least, and we would add to these longs. First of all, the original basket from the Citrini had a lot of names in it, like STVN, ATS, WW, BDX, CI, CNC. We put on just Lily and NVO, honestly. We don't like any other names right here from the trend perspective. And the thing that we like is putting on these two baskets alongside the Lily and NVO, the biopharm and body composition therapeutics therapies. So yeah. So this is the plan. Within that consolidation I'm currently having, adding more into this, adding more, even though we have already big position, adding more into Lily and NVO, putting on the GLP-1 shorts. And this is the other thing how we're playing this. Yeah, that's clear. GLP-1 shorts. Let me GLP-1 shorts plus biopharma. Makes a lot of sense. Lily, we are using Lily as a essentially telltale sign for us what's going on with the whole complex of these names and the whole basket. And Lily just created an unbelievably strong signal. Very rare, but very, very potent and very strong signal. That's why we've been able to accumulate most of our position on Lily in that region, in around $580 right here, just before their spike. We essentially, after that initial hype, in the beginning of the hype right here, consolidated in that region, as you can see right here. This is your point of consolidation. This was your previous earnings report, and well, you don't have an outside trading hours right here, but what happened on that trading report, and we received this massive spike week into this level. This essentially instituted the tail support for Lily, and what we did is we consolidated right here for a long time, taking out the last liquidity. This is the concept by using which we've been able to call this 4150 on SPX. This last liquidity on SPX in this latest retracement on SPX was at 4150, and when we hit it, first of all, this was our target, and when we hit it, we said, holy smokes, yeah, this is the time to retracement, consolidation, and rebound. This is essentially what happened. Same thing here. When you have a positive trend, positive tail, prolonged consolidation within that positive trend, positive tail, with taking out of the last liquidity, this sets you up for a very strong move higher. And we would not be surprised if Lily reaches 700, and usually these things outperform and maybe even going higher. I'm very tempted to add more into Lily. And if let me once again look at the beta component in Lily overall. This is daily, and you can see how overall in itself it's very resilient to the drops, while SPX is printing lower highs right here. Lily is printing higher lows right here. And within this consolidation period, this wasn't your inflection point and a catalyst from the flow perspective. Now, look at this. You have this drop and break in trade in SPX, while Lily is absolutely exploding to the upside. We will continue to see this outperformance of Lily, we believe, but if we do see another move lower in SPX and Lily consolidates and drops a little lower right here, this will be a very, very great opportunity to add into Lily. This is what we're doing, and we will probably add even into Lily even more, maybe even buy calls. So this is what we planning on doing, and this is your another basket. First of all, shipping basket. Second of all, GLP-1s through the names such as, you can look at all of these names if you want. Lily NVO, put on some shorts against this. The shorts that we like most are MAD, HLF, QIPT, POD, AHCO, but ratio like 1 to 3, and add those biopharma names as I showed you right here. These are the once again coming from Citrini, these baskets of biopharma names right here, and we plan on adding them, but in a maybe like 5% of the account of the nav dedicated to them. So this is the idea. This is the idea, and this is the plan. Let me just check this, please. LLY, and options, strat, build, long call. How about this? How much does it cost? Our view that if we are correct on, in order for Lily to reach 700, first of all we need earnings to be great, and we believe the earnings will be great. If the earnings doesn't let us up, doesn't let us down, I'm sorry, and we are correct in timing of the beta component, meaning the timing in SPX, and QRA comes in fine, we think this might be very, very promising stuff. So if we're correct in the timing, and beta and SPX will pick up going into the February, going into March, especially going into the March. Let's look at the March and May calls, out of money calls. Out of the money, we're gonna go. This is May, and this is March 15. This is your expiration. A 700 call. It costs $1,000, somewhere in around that region. 1,000. There is a, if you willing to dedicate, well, let's say 0.2, 0.3% of your capital into buying those 700 calls, we believe this is a very nice opportunity to do so. I mean, it offers an asymmetric return. We believe that buying those out of the money calls will make a lot of sense to us, honestly. That is fine. May cost 2,100, and yeah. So this is the idea. Maybe buy out of money calls on Lily as well. So this is the other play that we're looking at. Give me a moment. CRVD, MU, fiscal. Long AI beneficiaries, NVIDIA, Marvel. You see, everything that we are putting on right now is with that cross-asset class analysis and beta component that we just explained. NVIDIA and Marvel and other AI beneficiaries. Well, there are a lot of AI beneficiaries, and the basket for AI beneficiaries is huge. There are plenty of names from Japan, plenty of names from Taiwan, but we are sifting them through the lens of our signal and taking on right now the concentrated bets in we think the best plays currently. And these are the names. There are plenty of names: AI phase 1, phase 2, phase 3, and there's NVIDIA. Once again, this is all for the next 2, 3, 4 months. These plays, and we are cautiously stepping into them, meaning we're not buying the full position, we're not putting the full position on right now, unless we're accumulating in that region, as we just outlined on SPX, unless we're getting a significant inflection point on a trading basis. This can be reaching the key level, key area of interest. This can be breaking and creating the high low on a trending basis. This can be run on trade. This can be everything, but we're looking at that currently and putting on the small size on these names. And names are as such from this basket, from this thematic basket, and the theme that behind them is Nvidia and Marvel. Why Nvidia and why Marvel? After that initial move right here, an initial gap higher, Nvidia has been stagnating in that region for a while, for a long time right here. Irregardless of what you think, it is too expensive or it is still cheap, we don't look at this like this. We look at this on a relative basis, and through the signal, through the beta component, look at the beta, look at the timing, and look at the signal on the individual name and idiosyncratic component on that individual name and make a decision on that. We almost don't incorporate the fundamental. No, we incorporate the fundamentals, not the nominal values like PE that it trades at a million times sales. It doesn't matter for us. What's the growth rate and what's the rate of change within all of these metrics that we just described? And I think everything remains positive for Nvidia. And the fact that we, first of all, if you look at all of our other names, if you look at the AVGO, ASML, AMD, if you look at the phase 3, phase 2, if you go through all of them, Synopsys, AMKR, ANET, ASX, if we look at the SPX as well, all of them broke the trade. All of them broke the trade. It doesn't mean that this is not a good buy still. This is, I think, they will outperform the S&P anyways going into the 2024, regardless of what SPX is doing. But all of them broke trade. 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 And Nvidia, on the other hand, has been consolidating. First of all, the fact that this name, which is on everybody's radar, is creating this sort of a positive underlying flow dynamics, and it has created a tail high low right here by taking out this trend high low and creating another tail trend high low right here, and taking out and creating another tail trend high low right here. This just points to the potential good move in Nvidia relative to other space. Essentially, the whole AI space and whole AI basket has been outperforming Nvidia after that initial move. Yes, Nvidia has been consolidating, and the rest of the world, AI world, has been going higher after that. Right now, Nvidia is consolidating, and we think is on the verge of printing a nice move higher, and the rest of the basket is experiencing relative weakness. This is a good setup, we think, potential setup for a breakout higher. This one of the interesting dynamics to point out here. Right here, we've been calling for a negative flow and a potential negative move in Nvidia, and all of that with the mind that SPX, if you remember, yes, SPX has been building these lower highs because of the massive issuance and spiking yields. And Nvidia, we believed right here, right there, we shorted Nvidia on that day, and we said that if this move in SPX continues, if we break this 400 region, there is a good chance that we're gonna gap lower and continue lower, because there is no supported flows below 380, below 350, and to go into 340, 330 into the heartbeat would be very easy for Nvidia. But what happened right there? Underlying beta dynamics shifted significantly, and even though everything pointed out to the short on Nvidia, you have to change your opinion and change your position when Nvidia turns positive, when flows turn positive, and they did. And this, on the other hand, because we broke this trade support right here on this day, we put on Nvidia longs and said that Nvidia is a long from here, undeniable long from here, and all of that created a massive structural support for Nvidia in around 400 level. And now, this is very interesting, honestly. For two straight earnings reports right here and right here, this was your first cyclical all-time high for Nvidia, yeah? We came into that. We actually made nice money on the 480, 500 call spread. We closed it just at the open, on this day, and you've seen that we were unable to break into the all-time highs and to establish another move higher from here, even though the earnings were incredibly good. They were incredible. They were very, very strong, confirming this thematic flows that coming into the Nvidia. And then the other interesting thing, we're coming into this area once again in the same area of interest, same previous all-time high. All-time highs are always a very strong level, a very psychological level for any name. We're coming into this, and once again, earnings are great. Not as great, obviously, as we've seen right here, in terms of the market impact and the wow factor, but they are very stable and steady, in line with their expectation, and they beat the expectation once again, and we still unable to break it. If we are correct, once again, if we are correct in beta, if we are correct that SPX is doing what it's doing and consolidating right here as it does after this massive move, and will continue to go higher in March and revisit all-time highs, with this earnings report, we believe if beta once again accommodates, there's a good chance, if Nvidia doesn't disappoint, this is the asymmetry essentially. We're gonna break this. Finally, we're going to break this level. No level lasts more than two or three times, or maybe, well, I've never seen 4 times, but 2 or 3 times. And there's a great chance that we will see not a massive move, not this kind of a move higher, but a finally this move out of this prolonged continuous consolidation that Nvidia stayed for 1, 2, 3, 4, 5, 6, almost 7 months. 7 months after the initial shock and repricing higher and the beginning of the hype, and the fact that after that beginning of the hype move, we've consolidated for 7 months. We haven't seen anything like a peak hype pattern on Nvidia where you see this and then this. No, this is your move consolidation, and this will once again better accommodate just a natural continuation. And what we did is once again, everything has to be all else equal. CPI doesn't print 25 next week, or cure rate doesn't surprise us with 10 trillion of issuance. If model outcome remains the same, if we correct on our model outcome, and there's a good chance when Nvidia finally if earnings come out, well, Nvidia will likely beat again. Well, because it's Nvidia. Don't underestimate what they're capable of. They've shown this many times before. They're rolling out new products. By the way, I have to read more about them. We bought March 15. We have this one earnings report incorporated into this earnings report. March 15, 540, 550 call spread. As simple as that. And the asymmetry we think embedded in it is very promising. Why? First of all, the asymmetry embedded into the option itself. This is it. I can show it right here. Saved trades. It should be right here, right? Yeah, bull call spread March. Yeah, everything's correct. Profit loss in percentage points 1 to 3 essentially. 2.9. Yeah, you're risking, if using one contract, you're risking 262. You're making 737 in around 1 to 3 ratio. But in reality, we're not going to be holding them this position if we break the trend support, and the trend support is 470, 460. We accept the possibility that we might see a move right here, maybe even taken out of this low, which is highly unlikely, we think, but if that happens, well, that happens. The risk right here will be 460. Let's say if that happens in a month, let's say your rate comes in absolutely horrendous, Wednesday, February 1st, 460, you're risking $160. Mind you, the volatility will likely increase going into the earnings itself, because earnings on the 21st of February, volatility across these two contracts averages 38. Volatility will pick up, undeniably will pick up a couple of percentage points, and your risk in around 460, 470 will be 142, 140, 110. And if the best case scenario materializes, and we believe it will materialize, and if it will materialize, it will be good. We're not going to see this slow grind higher into 520, into 530. It's not going to be slow. It's probably going to be something like this. It's probably going to be a nice move higher. And this is your 550, and well, we're probably going to be holding it past the expiration, past the earnings, and there's this earnings 21st of February and 21st of February, and the vol after the earnings obviously will crush into this steady 25, your average over the past. Oh, I'm sorry, I've been talking for so long. Over the past year, I don't remember the average, but something around 26. It will be a nice return on your investment, well, we believe. And if we do get this move higher, this will be a lasting move, and holding it through March 15 and gaining the full max profit, I believe there is a great possibility of that happening. With risking $160, $200, you stand to make $700. Seems reasonable. That is NVIDIA. That is NVIDIA, that is the state of AI, and this is how we think of playing AI basket right now. This all in line with the overall everything that we're talking right now, and the trending trades are all in line with the what we think is going to happen with the beta. The next thing is Marvel. MRVL. QF research, everything. First of all, this trade idea 8A long Marvel. In the same manner that semiconductors came into the focus because of the overall AI demand, I believe networking, NVIDIA, Arista Networks, Broadcom, Marvel, Cisco will experience the similar moment in 2024 as attention turns to the bottlenecks that exist in the networking technologies. At some point in 2024, the inventory correction will bottom, while AI demand remains strong, and these companies will be in a sweet spot where they are up against relatively easy comps and relatively cheap forward earnings. Also, as the hyperscalers invest both in their own networking solutions and new technology from networking providers, this should continue to advance developments in AI, and Marvel stand to benefit from it. And once again, everything supports that conclusion, and this was the earnings report, the previous earnings report on 30th of November. Now, there was a JP Morgan conference, and Marvel was there. This QF research provides very, very great insights. They are seeing very promising signs of a picking up, of a cyclical pickup in the business right now. First of all, what we like. Our general outlook on beta is positive. I've said it a million times this time already. This is one of the main beneficiaries of phase one main beneficiary of AI theme, which is in itself a huge theme behind it. Secular positive trends and picking up cyclically within the positive beta, within the positive market, and this is and in itself the name is quite suppressed currently on a nominal basis. So on a absolute basis. So I mean, it looks like a good opportunity. Things changed for better just in 1 month since Marvel earnings call. Sounded much more bullish yesterday at CES fireside chat with JP Morgan. Biggest change is custom ASICs transcript not up yet, but huge customer pulls to get these into production. Marvel didn't change 800 million. There's plenty of things he goes into F25-26 run rate target during earnings call, but not expects to significantly exceed that target. Hyperscaler's custom chip definitively stepped up recently. Obviously includes Trainium and Inferentia. Talked much optimistically about innovating switches and Innovium switches, which haven't gotten as much attention. Sampling 2 trillion Terra Linux switch, which competes with a VGO Tomahawk market share, can only go up from here. Finally, conditions for enterprise carrier 5G and storage sound unchanged but more. Willingness to discuss undershipment, inventory consumption, and for storage, improving SSD and HDD markets, evident from improves changes, secular plus positive cyclical by second half 2024. All good for AVGO as well. The thing with AVGO, we've been observing closely these two names, and this guy completely. This is, by the way, this is what happens when you get a positive market dynamics within. At the same time, when you get a positive underlying big theme behind a name and a positive secular dynamics, cyclical dynamics as well, and a good earnings report, this is what you get. And all signs point to the fact that Marvel might experience the same thing right there. From the perspective of the signal, this was a very easy pick up. Huge consolidation. By the way, just as Nvidia is doing right now. No, not like this. Huge consolidation, and then we came out of the consolidation. Positive move in SPX, and then good earnings report. Absolutely exploded to the upside. And by the way, this is just this move lower that we experienced in AVGO doesn't point to anything but a normal mean reversion. I mean, after such a move in a couple of days, it's just absolutely normal. Marvel, at the same time, has been lagging behind, even though being in the same boat as AVGO. Marvel has been lagging significantly behind AVGO, but now all the signs that they are picking up cyclically. And if we are correct once again in our beta analysis, class analysis, there is a good chance that Marvel, we might see something similar happening in Marvel. First of all, positive trend, positive tail, positive trade, and we've just as we just looked at Broadcom, and we've seen this massive consolidation, breakout, retest, consolidate, move higher. This is a prominent level in around 60 for Marvel. We've seen it interact with it for a lot of times. It is indeed a very prominent level, and we broke trend going through this, and this is the first retracement and this first break in trade. This is the time to buy Marvel. From the perspective of the signal, this is the time to buy Marvel. If we are correct in our beta assessment, if we are correct, if earnings come in good, 66, 70, 72, 75 by March. By May, March is very, very reasonable for Marvel. That's why we bought 60 calls. Calls strike at 60, May calls strike at 60. As of now, once again, as you remember, we are lagging into these positions. We're not accumulating the full size positions currently, but we are lagging into these positions. And now we bought 1/3 of the calls that we wanted to buy. Same thing with Nvidia. We bought 1/3 of the calls that we want to buy. Now let us see what happens with the beta CPI, beta QRA, and then add to the positions. This is how we play. Only 2 names in the broad topic and the broad these concentrated names, and we want to go very concentrated in them and very big when the time comes, when the signal finally arrives. But this is what we're doing now. This is regarding the AI beneficiaries, long blue color thesis, UTI. Not gonna go into great detail, but another great thesis for 2024, and relative outperformance of all other names in the basket. Great fundamentals and great relative strength relative to the beta. I don't know what to add. Just long, just a long. We just long UTI right now. The next thing, long Unity as a potential takeout target. We just Citrini proposed a long short, but later on we changed just for long. And from a perspective of the signal, this looks promising, looks very nice. Completely dependent on beta. If SPA drops lower, more Unity will drop down to $32. But if we are correct in our assessment of what's going on with the beta, once again, we might see 44, 48, and if it comes in $50, if the takeout target comes in $50, is reasonable, absolutely reasonable for Unity. Just a trade, very small trade for us, meaning the sizing is small, and if it drops down to 32, we will add to Unity. This is Unity, long short BRKB Apple, long short BRKB Apple. Well, this is just a neutral trade. From a delta perspective, this is completely hedged. We described this in this post. The way we put this, there are a lot of reasons why I can write down. You should read it. Just read it. I don't want to read it anymore. That's one thing to say here. Berkshire holds 40% of their public portfolio in Apple, and you would think that, well, with this huge allocation, if Apple goes down, Berkshire has to go down. Not really supported. Well, if Apple drops down 40%, I guess, yeah, we will, the whole market will feel it anyway. But we see just relative underperformance of Apple, so Berkshire should be completely fine in that scenario. And Apple is squarely into, just read the reasoning in the post, and Apple is squarely into the negative territory, and BRKB is squarely into the positive trend territory. Couldn't be any better. That's one of the trade short. Going into the, well, essentially what we do now, as you can see, we are adding into the positive beta position. All of these can be considered as a positive, adding into the beta delta dollars, more into beta delta dollars, getting more equity exposure right here. All of this. One thing to go short, to hedge it going into the CPI, which we think anyway is a high probability trade, is short SOFR U24 futures as a higher for longer play. And this is what we did with this slow accumulation of no, give me that, of positive beta exposure. We are short SOFR futures, and we're probably going to hold them through CPI, and let's see what the CPI brings us. CPI comes in higher than expected, let's say, then these guys will offset some of the losses on our beginning, the initial positions that we built in beta. What we're going to do, we're going to take some profits right here on SOFR, and we're going to add, even if CPI comes in higher than expected, the worst case scenario I see is a fall down to 46.50, 46, and once again consolidation in around that region. That's it. We're gonna add to those longs that we just discussed, and we're gonna take profits on SOFR. That's it. This is how we're gonna play this. This is how you accumulate this beta exposure. Long BRK, we discussed this. Lily and VO, we discussed this as well. The other thing is couple of other plays. Yeah, let's go through the couple of other plays. UTI, we discussed that. In terms of the long EIB beneficiaries, in that thematic basket, what we think of doing is with that position that we begin accumulating in those names that we discussed in video Marvel, we think is prudent while SPX is exhibiting these negative trade momentum, negative flows on the trading basis. We think of putting on 1 to 3 once again this basket, this short, essentially short this basket of AI losers, and yeah, we're gonna do this next week. We're gonna put AI longs. Now we're gonna put GLP-1s, biopharma plays. We're gonna put on short side of the GLP-1 trade as well. The other trades we discussed and the other trades we're gonna be putting on are, yeah, this is it. Now we left the thing left to discuss is Agua, and yeah, let's just get into it. Agua. What can I say? EWW. You remember what we just discussed in SPX, and EWW is a much better play than SPX. If you want to play, let's say, if you have a option to buy SPY or to buy EWW, you buy EWW. At the time when we had this inflection point, we said, don't buy SPY, buy EWW, and yeah, we've seen this outperformance of, let me just EWW divided by SPY. This is what you're playing. Well, except you're not shorting SPY, you're just buying EWW. The outperformance is quite significant, and the signal is beautiful. Wow, it is incredibly beautiful. A very clear, very beautiful signal. After the first shift in tail and trend, creation of tail high-low, first break in trades into the key area, you always buy that. You always buy that. Even if we're going to revisit 64, 63 again, this is once again the area for you to accumulate the position. But if you want to play WW, you're welcome. If you want to play Agua, you're welcome as well. And you can see this relative positive outperformance in Agua. And how we think of doing this right now, we completely missed this, to be honest. This is just bad. This is, we had our heads full with the positions that we already put on, completely missed the Agua play. We would have bought this on this day, definitely would have bought this on this day. Right now, what is left is if we're getting negative CPI, we're going to buy, and negative CPI will impact the SPX, will impact EWW. Agua will retrace a little again, and we will start building position in there as well. This is one of the places to be mindful of. The other thing is, oh yeah, a small cap value. IWM, by the way, we haven't gone through the indices, but all of them is pointing to the same thing as the SPX pointing out. We've been in this consolidation, IWM, for a long time. I mean, long time. Years, literally years. And we believe this marks the beginning of a somewhat meaningful repricing out of this range. 210, reasonable, over the next Q1, Q2. We believe this is a reasonable bet to make with the overall macro that we discussed, overall situation that is at hand. And if you want to buy IWM, there is no better place in the world to buy it but in this 190, 185 region. This is the place where you add to IWM longs. IWM points to this thing, IWC points to this thing. EWW, once again, everything points to this. What they're thinking, if we're getting this move lower in the IWM into that region, as well as the SPX into that region, we are putting on these two baskets. Citrini, a small mid-cap value. He narrowed it down. He took IWM and narrowed it down to 50 companies. We narrowed it down to 20 companies, utilizing the signal, and this is what we ended up with, these two baskets, and we're gonna put them on as soon as we get this move lower in IWM. This is the idea. This is what other thing that we're looking at. These are the names in these baskets. This is all the green ones. All the green ones are the naming these baskets. The other thing is fiscal. Fiscal beneficiaries basket. We once again, there are plenty of baskets, and Sid already put this on, narrowed one, but we narrowed it even more, and we narrowed it down to this. This is the basket. These green names. This one, fiscal. Just never mind fiscal design. Don't like anything there. Fiscal beneficiaries IIGA and fiscal beneficiaries HVAC. This is This is not the basket. That's the idea. This is the trade. This is the idea, and here we have it. Plenty of things to do. Plenty of things. If we are correct in our model outcome, then the model outcome is we discussed. Have I missed something? Oil. Once again. So far, no indication on a trending basis that we are breaking into the upside. We are potentially creating a higher low on a trade basis, but until we break the 80 region, I don't see us going much higher from here. Gold, we still long UUN. We still long UUN. We took profits on CCJ, CEG, but we have like 1/3 of the position left on the names, on the equity names, but UUN we have almost full position on. We took a 25% off. That's it. We talked about the gold short term. I don't have anything to add of value in commodity space, fixed income, and overall pricing of in rate complex. We discussed this. We discussed credit. We discussed this. We discussed EWT. I'm thinking of putting on Japanese EI beneficiaries as well, but until we get moved lower in SPX, I'm going to put this off. Same thing as Taiwanese plays, but I'm going to put this off as well. Poland is interesting, another interesting name, but there are better places to do. We still have a lot of things to do. China, is worrying me. Worries me a lot, because this continuing down the performance and these problems, deflationary tendencies in China, they will eventually spill out into something bad. Something. The culmination shall come. The culmination always comes, and we shall see how that manifests itself in economic or geopolitical tensions. Geopolitical tensions are already happening, but will there be a culmination? This really worries me. Apple, Tesla. Looking at Tesla as a potential Tesla earnings play. Continuous underperformance of Tesla points to we're getting very close to earnings, and there might be a chance to play it to the downside on Tesla. Listen, that's it. Yeah, I think I've gone through everything I wanted. So thank you for listening, and till next time.